put as little money down when you buy real estate as you possibly can, because the cash that you have can earn greater rates of return than buying down a rate. The pink elephant in the market. Maybe you guys have heard about this. Biden to hike payments for good credit home buyers to subsidize high-risk mortgages. How many of you guys have heard of this? Okay, so let me explain what this is so you know how to explain it to our customers. Home buyers with good credit scores will soon encounter a costly surprise. A new federal rule forcing them to pay higher mortgage rates and fees to subsidize people with riskier credit ratings who are also in the market to buy houses. The fee changes will go into effect May 1st as part of the Federal Housing Finance Agency's push for affordable housing, and they will affect mortgages originating at private banks across the country. The federally backed home mortgage companies Fannie Mae and Freddie Mac will enact the Loan Level Price Adjustments, or LLPAs. Mortgage industry specialists say home buyers with credit scores of 680 or higher will pay, for example, about $40 per month more on a home loan of $400,000. Home buyers who make down payments of 15 to 20% will get socked with the largest fees. So, if you have good credit and 15 to 20% down, you will pay the most in fees to this new tax. So it's a tax on responsibility and good stewardship of money. That's what it is. So I want to change everything I've been teaching you guys for the last 20 years and tell you, have terrible credit, be broke, and all these incentives are available to you. The new fees will apply to Americans buying houses or refinancing after May 1. So for those of you that have a mortgage, this won't affect you. For those of you that refinanced recently, this won't affect you. However, when you refinance or when you buy a house after May 1, this will affect all of us. So how do we all feel about this? Ridiculous. But aren't we doing a good thing by giving more money to the government so that they can subsidize housing for lesser qualified borrowers? I'm hearing a resounding no. Guys, we are a socialist society. This is socialism. This is good, right?
Does not compute. Does not compute. Does not compute.
Does not compute. Thank you for that, Peter. That's fabulous. Lenders and real estate agents say the changes will frustrate homebuyers with high credit scores and homeowners seeking to refinance because the rule pushes them for their relatively strong financial positions. So, what's the lesson? Well, I will say it supports my narrative, and that has always been put as little money down when you buy real estate as you possibly can, because the cash that you have can earn greater rates of return than buying down a rate. So if you guys right now qualified for a 7% rate of interest, but if you put 50 grand down, you could get a rate at 6.5%. Should you put the 50 grand down? No, guys, we can take the $50,000 down and go put it in some interest-bearing account that's paying 5. That'll produce an extra $2,500 a year, just putting it in some, high rate of interest mutual fund, which, by the way, mutual funds right now are paying about 6%. And that's the last thing I want to mention here, because this is going to affect funding. So you guys that are talking with investors, this is something interesting going on. Let's find it here. Here it is. Inflation-protected treasury rates remain attractive for many savers, but yields may soon fall below those offered by money markets. Currently, purchasers of I-bonds can get an annual rate of 6.89% for the next 6 months. Okay, so if you guys are talking to investors, you're like, no, I'm not going to do real estate. I'm not doing high equity funds. I'm not doing note acquisition. I'm getting 6.89% in an I-bond. That's currently true. But as of May 1st, that's going to fall to 4.3, reflecting slower inflation. So as you guys are on the phone with investors saying, I'm getting really high rates of yield right now in my money market accounts, that's about to slow down and end.